Hello, and welcome to the Power of Passive Investing webinar. We have an exciting topic today, and judging by the number of people that reached out to get the link to register for today's webinar, I think we're going to have a ton of questions for our presenter tonight. So let me, as usual, share my screen and go over our usual routine first before I give Tyler, our presenter, the floor. So welcome everyone to the Power of Passive Investing meetup. We are thrilled to have you here with us. As usual, the presentation is for educational and informational purposes only. Please contact your own CPA and or attorney for advice. We're not providing any advice, just sharing the information with you. We are asking you to potentially keep the questions till the end, and at the end you're more than welcome to either type them in or we can unmute you if you want to ask yourself. Matt and I are excited for so many people joining us and to have our presenter with us today, Tyler, who is a tax supervisor at Schneider. He is a CPA that focuses on 8- and 9-figure entrepreneurs and business owners. He is also an author of How to Budget for Wealth book, which he'll share with you the link at the end. It's a book focused on developing the strategies and mindsets needed to build wealth. He lives in Vegas, where he's happily married and has a 2-year-old boy and another baby on the way. Congratulations, Tyler. That's
Congratulations.
Awesome.
Thank you.
Yeah, as you know, so the topic for tonight is tax benefits of investing in car washes. And without any further ado, I will give Tyler the floor. Welcome.
Wow, thanks so much, Lena. I'm really excited to be here. I'll go ahead and share my screen, I guess, and we'll get started.
So Tyler, as you're about to kick this off, I know a lot of folks on the call here are interested in investing, and a lot of them thus far have focused mostly on real estate. I'm sure what you're about to tell us is car washes are certainly in the real estate sector, right? Given that's an operational real estate. So as you go through, we'll love just to see where the parallels are to real estate and bring some of that terminology or practices that we know in real estate, bring those along as well.
Okay, absolutely. Yeah, I'm excited. Yeah, it's an interesting topic. It's something that I actually didn't even know about until about a year ago, or just even a few months. And honestly, I think there's been people taking advantage of this for a while, and maybe it's just one of those best kept secrets that finally reached everybody else. Yeah, let me just get going here really quick with my quick introduction. So I am a tax supervisor at Schneider. My firm is kind of focused more on 8- and 9-figure entrepreneurs. And so that includes, we have like 88 clients currently that have net worths over $100 million. And so it's kind of a unique niche that we have. I mean, I guess a lot of CPAs would aim for complex stuff, but the truth is we kind of deal with that every single day. And a lot of our clients are real estate professionals as well. They have a lot of stuff going on. That's one of the things with investing with real estate is there are a lot of tax benefits and lots of tax strategies. And there's also a lot of tax compliance as well. And so we work with our clients to make sure everything's correct, accurate, and they're just getting the best treatment possible. So we have I wanted to mention really quick a couple of the unique things that we do that I don't think any other firms do. One of those is if you have a business and have a unrealized gain of more than $15 million, we do this strategy called basis shifting, and it actually does involve real estate most of the time. But the general idea is that we will put your investment into a partnership, and through the different partnership rules, we're able to actually shift basis from one asset to the other. And so when you sell that company, you can actually sell it for less of a gain. So normally when you start a business, you have no basis or very low basis. In this strategy, you can actually include some additional basis from other investments you have to offset that capital gain. We do tax planning all year long. It's, we try to make sure that we're always focused on our clients and what they've got going on in their lives, so that we can help them plan accordingly. And, I love real estate strategies, and that's kind of my focus with my firm. I did write a book about almost a year ago now. It's called How to Budget for Wealth. It's basically a strategy I implemented in my own life. It's helped me shift my mindset when it comes to different expenses I have. And I mean, I've been able to do about 35 to 40% of my net worth, of my income has gone towards building my net worth. So I think it's something that anybody can implement. A couple disclaimers. In fact, Alina actually covered this, but I'm not an investment advisor. This is not personalized tax advice. I do want you to make sure that you reach out to your tax advisor to make sure your facts and circumstances align and everything's good before you proceed and do any of these strategies. And then my opinions are my own. So if I do represent my firm, but if I say anything silly, don't think that Guernsey's responsible for that. So what this is not, I kind of thought maybe people would raise their hand or put their comments in, but here is a picture of a famous car wash. And I was just curious if anybody knew what it's from.
Is that from a movie?
It's from a TV show. It aired, I don't know, 5 or at least 10 years, at least 5 years ago. It had to do with money laundering and drugs.
Are we talking mafia movie? I don't recognize it.
Yes, this is from Breaking Bad. So basically the premise of the story is that this chemistry teacher knew how to make methamphetamine. He was diagnosed with cancer and decided he needed to leave some money behind for his kids. So he started a meth business and bought a car wash to launder his money. And that's not what this is. So we are not saving taxes through any kind of illegal activities. This is 100% legal. And it is a specific type of car wash that does this best. It's also not mobile car washing. It's just not the right kind of asset class that would accomplish the goals that we have with this type of asset, being the car wash.
Yeah, a couple of people guessed it was Breaking Bad, but yeah, glad you covered that. So we know it's not the next episode in the series of Breaking Bad.
Yeah, I don't want to get anybody to get in trouble. That's not my job. So I'm not a shady lawyer or something, but okay, just making sure I have the time in front of me. So what this is it's an illegal way. It's a legal way to defer taxes through real estate investing. It is an alternative class, I suppose, but ultimately, when you get down to it, it's the components of in land, and it's very well tied to real estate. It is also a opportunity to have the IRS fund your next investment. The tax benefits are so good in the first year that you could potentially get a refund big enough to fund your next investment. It's a profitable business opportunity. There are some really, really, really profitable car washes here in Vegas. I know there's other big chains across the country, and I mean, they basically print money. So they're always very busy. I can't imagine they wouldn't be making money. And then it's a potential opportunity to add technology to improve profits. So if you are a little bit more sophisticated, you could potentially, buy an older car wash, improve it, and turn it into the same thing. So there would be some opportunities there. So basically how it works is you would buy a car wash, you perform a cost segregation study, and then you would operate the car wash. Pretty simple. In fact, it could be even more simple because there are certain funds actually that allow you to invest in car washes with a much smaller commitment as a passive investor.
Tyler, sorry for the interruption. I'm not sure that 100% of participants know what cost seg is, so maybe you cover it in a little bit.
Okay, absolutely. Yeah, it's I will cover it in a minute, but yes, it's a way to accelerate the depreciation that you have on a building or car wash, and it just basically breaks up the property into individual units or pieces that have shorter taxable lives. And anyway, I'll get more into that in a minute. So anyway, what type of car wash? Anything that's mostly equipment. So a self-service car wash might not work as well. You would probably want to talk to a cost segregation expert as you start in the negotiation process and due diligence process. They could probably give you a decent estimate of how well a cost segregation study will work for that specific car wash. But I would recommend any car wash that's mostly equipment. So automatic car washes are great, which is the next one. Obviously you want to try to find one that's profitable. And if it's not profitable, one that you can add technology to improve. And one other big suggestion with this is one that has brand recognition. So in Las Vegas here, we have a chain that's up, and I don't know if there's franchise opportunities or not, but the one that's in Las Vegas is called Wow Wash, and I swear, like, I signed up for a membership for it because honestly, it just does a great job and it's super simple and cost effective. And then there's also Tommy's Car Wash that I know is a really big chain out east, and they actually do offer franchise opportunities. And then another big thing is that you would own it and not lease it. So there's some implications there. If you're leasing the car wash or the property from the owner or potentially even the franchisor, which is the person who gives you the franchise opportunity, you might not and most likely will not get the tax benefits that are associated. So there might be some nuances there, but generally I would say try to avoid leasing the equipment and running the business that way. So I wanted to just kind of give you a quick kind of comparison, see where they're similar. So in a car wash, the value comes from equipment, and that produces the revenue. And then in commercial real estate or multifamily, the value comes from the building. So you're giving somebody a place to live or work. There's multiple employees. Same thing with a apartment building. There may or may not be 2 or 3 employees. It doesn't take a ton, especially depending on the car wash. So hopefully there's not generally there's not a ton of management expenses in that way. And then finally, there's the tax benefit here. And generally, I would say between 70 to 80, even up to 90% of the equipment and the value of the property could be eligible for bonus depreciation. So, and then with commercial real estate, and Alina, if correct me if you're wrong, because you probably even have more experience with this than me, but generally I would think with most real estate is between 20 and 30% that you can take for bonus depreciation.
We've seen more, Tyler. We've seen more than that, but then we get creative with the structure of investments in general. Plus, of course, we want to point out that this is the last year people can use 100% of that bonus depreciation.
Yeah, that's a great point. So there is a little bit of urgency here because you do get 100% of the benefit this year. As we go into the next 4 or 5 years, it's actually getting phased out 20% at a time. So 2023 is going to be 80% until it's all gone each year after that. And so here's the big question: how do we depreciate so much? Like, how do we get so much out of it? And so when you think about what the components of a car wash are, it's mostly equipment or land improvements. So obviously, well, maybe not obviously, but when it comes to buying property, there's always a land component. And so that same within, multifamily, you usually can't depreciate potentially, about 20%, maybe 25 or 30, depending on the location. Then there's equipment, and these next asset classes, including equipment and land improvements, are actually eligible for bonus depreciation. Equipment usually typically has a 5 to 7 year useful life, which is how the IRS kind of judges it's the useful life is how long you're able to depreciate the asset for. And then the land improvements, that includes things like asphalt and pools and landscaping and things like that, that actually make the property more aesthetically pleasing and useful. So those are also eligible for bonus depreciation. And then finally, you have the building. Usually there's like a small office where the employees clock in and clock out, or maybe run the equipment. And that portion of the car wash is actually quite small in most cases. It has a much larger life, 39 years, because it's commercial property. And so you're actually not able to bonus depreciate that portion of it. And then, as I mentioned, we need you to talk to a cost segregation expert. I think I pretty much covered what cost segregation is, but as a reminder, that's basically you break up the components of a building or a business or a car wash in this situation, and you determine the value or the value or the I guess, yeah, it would be the value of those components, and then you're able to depreciate those components individually instead of the entire building as if it was all a 39-year life. And so that's where the extra tax savings can come from, because all of a sudden you might have a ton of components that in the aggregate, when you depreciate them all at once using bonus depreciation, it offsets a lot of income, creates a huge deduction there. So I think we probably can move on to the next example. So here's just an example. If you're out on your own, you might be able to do this with the fund, of course, as well, but just the numbers here to kind of illustrate. So let's just say you were able to put 20% down on $1 million apartment building. You would be out of pocket $200,000. You would typically, and this is conservative, just get about 20% bonus depreciation, which would offset $200,000 of income. If you're working with Alina, you probably can find some properties that have more. But and then your tax savings from that, let's just say that you're in the 37% tax bracket. I mean, really, this could change substantially. You could be in the 10% bracket. You could be in a 10% bracket and be in a state. We are based mostly in California. I'm in Las Vegas, but my firm, we deal with a lot of California clients, and their tax rates effectively, in a lot of cases, above 50%. And so anyway, at 37%, you'd save $74,000 of tax, which is great. That's fantastic. I would recommend that for most people. Every once in a while, you do need to insert, depending on the circumstances, you might need to find more savings. And the way you could do that is potentially through a car wash. So here's the other side of the coin with a car wash. If you were to put 20% down, you'd be out of pocket $200,000. If you took 70% bonus depreciation, you'd offset $700,000 of your income. So if you had a large amount of income coming through somewhere else, it could potentially offset it. Now, this is where I would say talk to a tax advisor in both situations. Make sure that you understand where that income's coming from. There are 3 different buckets of income. And so if you have income from one bucket, it cannot offset the other. Those buckets are active income, passive income, and investment income. So in real estate, usually is in the passive bucket. A few people can get into the active bucket. Tax savings on that, assuming the same tax rate, would be $259,000. So I'm sure you could imagine how powerful that is. I mean, you can make an awful investment and still have $59,000 extra your first year, get a 100% return of capital, and boom, you also had $59,000 to go fund your next deal. Obviously, you want it to be a good investment, but this in a lot of cases is actually, as well as an income play, it can also be a tax play, absolutely. So the other thought is, idea with this is, if you're familiar with a 1031 exchange, you could potentially use it in lieu of one. In fact, that's my next slide. I guess we're waiting until the end for questions, so I'll move on. This could work for 3 different people or 3 different circumstances. This would work for a qualified real estate professional. If you're unfamiliar with what that is, it's basically somebody who's in the real estate trader business. Alina probably is one, I would imagine. And basically they are actively involved in real estate. They have at least 750 hours of participation in a real estate trader business. And they also actively participate, the other part with that hurdle is that they have, it's more than 50% of what they do. So most W-2 people cannot qualify. And the final hurdle is that they actively or materially participate in the activity. And with a grouping election, you could actually group, for example, let's just say Alina was active with managing properties, and then she passively invested in a car wash fund. She could potentially group that passive activity in with her active real estate activities and use that as active. So there is a grouping election that people can do in her situation. It also is really strong and good for passive investors. The biggest thing that I would say with a passive investor when it comes to bonus depreciation is that you're basically stacking tax assets. A lot of times, if you get into a apartment fund or something like that, they're going to take bonus depreciation, and it's really good for the active investors, and it's also extremely good for the passive investors. There's really no reason you wouldn't want to accelerate that depreciation. And so what you do is, as you can't take passive investors actually can't take passive losses. So you can have passive income, but you can't have passive losses if you don't have other passive income to offset it. So basically, let's say if you had a $10,000 loss, it was passive, that loss gets suspended and carried over to future years. And it can be used to offset future passive income. And so that's called a tax asset. And this is a great way to stack one of those up. So if you know in the coming year, you're probably going to sell out of a fund, they're going to sell the asset. You have a huge gain coming through. You could actually go in and stack that loss against it proactively to offset your future income. And I don't want to get into too many of the nuances. There are things like different types of gains there. And so it doesn't offset all of them. It doesn't offset 1250 gains without getting in the weeds, but it does offset the majority of the gain moving forward. And then the final thing is a 1031 exchange. Basically what a 1031 exchange allows you to do, and this is not this would be instead of it, but a 1031 exchange would allow you to, okay, I'm good on time still. It allows you to exchange a property for another. And so you actually, instead of recognizing a gain when you sell a property, you can roll that gain into another property. As long as you don't touch any of the proceeds, there's there's no boot involved, which is just kind of extra cash that you pull out of the deal. You can actually forever defer your tax gain when you sell. And so this is a creative opportunity similar to the passive investing strategy. Is if you sold a property, what you could actually do is go purchase or acquire another one, such as a car wash, and use the depreciation to offset the gain. And so instead of having to do a 1031 exchange, which can be difficult, you do have to find a replacement property within 45 days if you do a 1031 exchange. You also have to close on the property within 180 days. And so this actually could, help you potentially take longer to find and identify your property. There's just a lot less red tape in that area. So you could potentially do this as like a 1031 exchange light and use it to offset a large amount of your income. And so anyway, as Alina mentioned, it is the last year for 100% bonus depreciation. 2023 will be 80%, and then it will be quickly moving down to 60, 40, 20, and 0, pending any additional litigation or, any additional legislation that comes through. Now, there's a potential softening of the purchase price with rising interest rates. If you have a really good cash flowing business, the interest rate is less of a concern, and so the purchase price can go down quite a bit, and it might give you a better entry point. There's improved technologies in the industry. I know that 5 years ago, you couldn't, the car washes were not as good as they are today. There's opportunities for subscription models. There's better results now that automatic car washes can do. So there's an increasing popularity there. I do have a couple of resources that I can give you. I actually found this one on the first one. It is a fund that is currently being done for Tommy's Car Wash franchises. This is from the Get Rich Education podcast. The guy jumped on there recently and was advertising his fund. And so he talks all about it, a little bit of the details that I discussed. I think I got a little deeper than he does. But the idea is that, yeah, you could just, I don't know, I don't remember what his minimum investment was, but say you had $100,000, instead of having to go through the whole complex closing process, you could just invest in a fund passively. Tommy's actually does offer franchises. So it does require a bigger capital outlay, but it's like $1.5 million. But if you have that, they give you all the support you need to be a franchisee. And then you could also buy from an existing operator. This might be a good opportunity. We do have connections with some business brokers. They have like a whole list of car washes, and we quite often go through those with our clients. But yeah, so you could probably go to like Business Buy Sell or something, like a website, and just contact a business broker and see what they have available. And that's about it. So here's my contact information, but I'd be happy to answer any questions anybody has.
Awesome. Thank you, Tyler. This was very informative, detailed, and we definitely appreciate this, overview of a new type of investment, because most of the time we do talk about real estate investments here. So I see Sam posted a question, and I have a couple of questions, but folks, feel free to post yours either in the chat or Q&A. So Sam's question is, so you cannot accelerate depreciation on a building/structure?
Yeah, so I think what you're referring to, Sam, is I mentioned that the building itself is a 39-year life. So if we were like to look at a typical apartment building, you would normally, if you go to your typical accountant, they're going to say, okay, well, 20% of that is land, 80% is the building, and to answer your question, yes, you cannot accelerate the depreciation on that. But if you do go to an expert and pay for a cost segregation study, they are able to they actually have an engineer come out to the property. They look at each component and they break it down into the useful life of each component. So, you might have washing machines on site or something like that, and those actually have a much smaller life. And so you can get a lot more bonus depreciation or just accelerated depreciation after doing a cost seg. So I hope that answers the question.
Yeah, thank you, Tyler. And then my question, so you mentioned 1031, and you mentioned a few times pigs and pals, the passive income gains offsetting passive activity losses. So essentially, we can take the gains and or losses from car wash investments or purchase and offset gains or losses from real estate, as long as they qualify to offset one another?
Yeah, so that's a great question. Spot on. I mentioned the 3 different buckets, just kind of break it out for everybody. You have your active category, which is usually your W-2. You have your passive category, which could be any investment in any business. And real estate is by default considered passive unless you qualify as a real estate professional. And you could be passively invested in a business. And so if a fund would be an excellent example of that, where you're an investor in the business, you own capital in the business, but you actually aren't involved in it. And so if you don't materially participate, and that would be the big thing there, is if you went out on your own and bought a car wash and started being the owner operator, you would actually be trying to not materially participate if all the rest of your stuff is passive. If you're an active real estate professional, you could go actively participate or do a grouping election and get it all into the active bucket. And then I think I didn't really explain what the third bucket is, but it's investment income. It's like interest, dividends, things like that. Does that answer the question?
That is still ordinary income. Yeah, thank you, Tyler. And
Correct.
that the same concept applies to 1031. So essentially, you can 1031 into a real estate property.
Correct. You would have to make sure all your ducks are in a row on that one, and probably, you know, talk to the intermediary and your CPA. I would say in most situations you could. It's not too much of a stretch, I don't think, to get into other commercial real estate. You might have a harder time with residential, but I would say most cases you could probably exchange out of it. Yeah.
Does it make a difference? And I don't know if the scenario exists, whether you own both the land and the business, or can you lease the place and you know, put your business there, which is car wash.
So yeah, and I'll send the PowerPoint later.
Yeah,
so anybody.
I'll share with everyone with the recording. Thank you, Tyler.
Okay, so the question was,
if you own a business but you
yes.
lease the place, I don't know if such scenario exists. I'm just asking because you mentioned 1031. I was under the impression that 1031 applies only to real estate, but it sounds like it may apply to businesses as well.
Yeah, so in this situation, you'd be 1031 exchanging out of, you know, you own the real estate, really. You own the land, you own the improvements. It still is real estate. I think that there might be a differentiation between maybe the value of the business versus the value of the equipment. But really, in a lot of cases, I think they're one and the same. I think you'd really want to be looking at your lease agreement there if you are leasing somehow. You know, if you only have claim to the actual operation, like you're only in charge of the employees, you don't have to do the maintenance, or maybe you could do the maintenance, I suppose. But if you don't have like title to the assets themselves, I don't think there's a way to 1031 exchange out of that.
Okay.
Yeah, so you'd have to literally own the assets themselves. And then same with the bonus depreciation, depending on what your lease agreement is. If you're just leasing the land, you can still get bonus depreciation. If you're leasing everything, you wouldn't qualify.
Sounds good. Then I see a few more questions from the audience. Chris is asking, how do you evaluate car wash deals? What are some of the important metrics to look at? Sounds more like a question for investor, because Tyler is giving us the CPA view, not the investor view. I'm not sure if you have any insight into this, Tyler.
You know, I would talk to the business broker or other investor friends. You know, we could do without digging into it. I'm sure we could find, you know, stats on, even a CPA could help you with this, but we could find industry stats, and I would try to find the industry benchmarks and then see how I measure up to that. I don't have any specifics. I can't tell you like a certain amount of earnings, or I don't have any of those.
Yeah, I imagine this is a business broker expertise, CPA. Anyway, next question is from Angel. Do you work with Americans living abroad working for foreign companies? My sister-in-law and her husband are GPs on our current deal and are trying to make sure the income comes in a way that's most desirable in terms of taxation. I guess it's not related to car washes, just related to CPA.
So Americans, so I'm guessing maybe Angel's living abroad and she's passively invested, potentially.
Her sister-in-law, yeah, I guess they are what do you call that?
General partners on a deal that she's working on.
I think the question, if I frame it, is let's just say a person is abroad and they're investing in real estate domestically here in the U.S. It seems like there's a question here about how to structure that income so that it's most efficient. Well, it looks like the other way. Angel is, anyway, I guess the example stays true. So someone living abroad, investing in real estate here in the U.S., how do you effectively structure that income so it's most efficient tax-wise?
Yeah, so I mean, it's going to come down to the same rules. If you're living abroad, you're still subject to the same like U.S. tax laws. So if you're an American living abroad, you're going to have the same tax laws. It's going to be the same implications as anybody else. You did mention that they work for Saudi Aramco. So for them, if they both work for Saudi Aramco, it's if they're trying to get the qualified real estate professional status, it's going to be just him. So what we'll do quite often for our clients is we'll have the husband might have a job and they worked as a W-2 employee, and pretty much there is no argument to say that you are a real estate professional if you have a W-2 job, unless you are like a W-2 job potentially working in real estate, but even then that's kind of a stretch. So what we'll quite often do is if the wife is not working, or vice versa, it doesn't matter who, but the spouse is not working, they can, as long as we can make them qualify as a real estate professional. Now there is a certain amount of work that goes into that. You have to work at least 750 hours a year, which is like 15 hours a week. So it's not an easy hurdle, but it's definitely doable for most people. So that would be the thing, is if they qualify as a real estate professional, they'll get all the bonus depreciation. And it's kind of the same as what we talked about. You just have to make sure you qualify.
Awesome. Thank you, Tyler. Tyler, is there a difference when buying or investing in car washes, whether you're buying a brand new one or buying an older one and then renovating it?
Yeah, great question. So it's going to come down to timing. So whatever's there when you buy it, so you can depreciate and do a cost seg on. If you don't place the new assets in service before the end of the year, you're subject to the next year's rules. So the sooner you can get the new stuff into service, the better. I do believe you could probably, there's probably a case for like disposing of some of those things, but if you've already taken bonus on it, it's not going to have much of an effect. But you could potentially accelerate something in there by disposing of it and taking a loss on something that was replaced. But again, if you took bonus already on it, it's going to be a wash either way.
So whatever you put in this year has to produce income this year in order for you to claim bonus depreciation?
Good question. That's a good question. I would say that if it's going to come down to how you're operating the business at the end of the year. Yeah, good question. That's a tough one. I would say, like, if it's still in operation, you're golden.
Mm-hmm.
If you have to shut it down and do renovation stuff, technically, I don't think that's been placed in service yet. So it's going to be based on your placed in service date, not your purchase date.
So you may potentially need to wait until next year when you're income producing.
Correct. Now, just because you bought the asset, you would just be subject to next year's rules. So you bought the asset in 2022, it starts operating in December, or not December, like April or something of 2023. That's your place in service date. And so you're subject to the 80% limitation for bonus. But you still get all the benefits, except for just you don't get that extra 20% of bonus.
Awesome. Amazing. Thank you.
Tyler, I had a question. Car washes being seemingly a great example of getting a higher rate of depreciation. Are there other assets outside of car washes, and obviously real estate is being one of them? Is there other operational businesses that come to mind that maybe are as efficient as car washes, maybe slightly less? Just curious if there's other options out there that are popular amongst folks.
The one that comes to mind first and foremost is mobile home parks. Most of the land, you could have a mobile home park that's worth, I don't know, $2 million, and it's right next to a vacant lot that's worth $200,000. And so you kind of thinking about it, it's like, okay, well, what does a mobile home park actually own? And it's like land and some landscaping and maybe a little tiny office on there, and then the rest is owned by the people who are leasing the land or the plot. So you can actually say, okay, well, then what is the value of the land improvements? And the truth is like, well, 1.8 million, you know what I'm saying? So there's a little bit of play right there with a mobile home park where you could go get a cost segregation study done. And again, land improvements are a 15-year life. And so that is eligible for bonus depreciation. Same with the building. Well, I don't know. The building, I guess, wouldn't be, but maybe parts of it. I don't really have any other examples that I can think of off the top of my head, but those are kind of like the two big ones.
Awesome. And then looks like Angel has a question. We got a deal closed December 17th last year and still got 2021 depreciation. It was prorated for the month. I would assume a business at any level of operation would be able to do the same thing. So they got a portion of depreciation before they closed in 2021, but then it was prorated into 2022. That's what I'm deducing. And Angel is asking whether it would apply to a business as
Yes.
well.
Yeah, exactly. It definitely would. It's basically the same rules for between a business, like whether you operate a business. Real estate is a business, and so they're the exact same rules.
And Tyler, this is mostly, you know, I don't know if such scenario exists, but I just thought of it. You mentioned real estate professional status a few times. So if someone just owns a bunch of car washes, I don't know, 5, 7, no other real estate, but they own, you know, the land and the businesses, would that give them enough hours to qualify as real estate professional if that's all they do?
That's a good question. That's a little bit, you know, I think you can make an argument that it's a real estate business, potentially. It's probably a little bit of a gray area.
Yeah, you're leasing the property to yourself, essentially, right? There is a company that bought the property, a property management, you're paying rent to them. Your business is paying rent, right? That's probably two separate entities.
You know what? I think if under self-rental, yeah, I think you could do it that way. See, this is why people pay you, to have creative ideas. Absolutely. I think if you could separate the two and keep the operating company separate from the I don't know, the company that owns the business, the rental company. Yeah, I think you could definitely justify that.
Got it. Okay, maybe I should get paid for my creative ideas. Thank you. Anyone else, Matt? Do you have more questions?
Yeah, I wanted to switch gears a little bit and maybe get a little preview into, Tyler, the book you wrote and some of the principles or concepts there, kind of key themes you might like, folks might look forward to seeing in that.
Yeah, so the book came from a lot of painful realizations that I was in some credit card debt. You know, I was like a slave to it. I was really good at paying my card off every month, but I was always like, everything revolved around my credit card payment, it seemed like. And so actually, when I was in college, I remember in the management accounting class that we took, they talked all about all this different kind of cost accounting that they do in a business. And I thought, you know, man, that would be really good in personal finance. And so I kind of had that on the back, you know, the back burner. It was like on a shelf. And then I read a book called Profit First, and they talk about taking the profit out of your business first, right? But it's for business owners, and they didn't really have much explanation on how to apply it to your personal finance. It was mostly focused on how to manage your finances if you're a business owner. And so kind of the book is a bridge between those two things. And so it helps me personally manage the different types of costs that I have in my life with other people as well. And the biggest, I say the biggest takeaway from the book is something that I call the wealth account. And basically the idea there is, actually I could back up and say one more thing, but I'll mention the wealth account first. Is basically that I have anything that creates equity in my life paid out of the wealth account. So I pay my mortgage comes out of there, and a large portion of my income goes into that account, kind of using the profit first method. But it kind of helps me keep a perspective that, okay, it's okay that I have some debt. Like, I'm pretty young, I'm building a life, I've got a family. And I was always like dogging myself because I was like, oh man, I'm not saving 20%. Like, this is awful. And so it helped me make a mindset shift and realize, okay, things like a whole life insurance policy that I have, or my car payment. Eventually, I'm going to own a car and it's going to be worth something. My mortgage, my house is appreciating. And so all those things come out of a brokerage linked checking account. It's just a checking account that I have with Schwab. And every month, as that balance gets above a certain threshold, I just transfer my money over to Schwab. But I'm saving basically, I got things broken into fixed expenses, and I never think about those things ever again. I put them on autopay, they're fixed, I never think about them. And then I have variable expenses, and that's the only thing I control in my budget. It just keeps everything simple. That goes into a separate bank account from the fixed. And then my wealth account is a completely separate thing. And I actually have my fixed and variable stuff coming out of there. And the idea is that based on what my income is, I might save 75% of my income 1 month, or a minimum amount of about 20%. So effectively, I've managed to save over the last year and a half since I implemented it, about 35, probably close to 40% now since I've had a pay raise. And that does include the principal payments on my loans. But outside of my loan payments, it still is about 25 to 30% total. So it's pretty great. I think it's something that I thought other people might find helpful. And really the biggest thing is that mindset shift, and then really just focusing in on the one thing that matters. Because I used to do the line items like, oh yeah, I paid Netflix this month, and that's just never going to change, and I never need to think about that ever again. So unless I cut it out. And so there's like, an opportunity to do that as well in the book. But
it sort of reminds me of the Richest Man in Babylon book, because he also talked about paying yourself first before paying any bills.
Yeah, and I guess that's the other big thing is and that's the one like manual transaction I ever make. Every single paycheck, I have some that goes automatically into my fixed account. The rest goes into my variable living expenses account, and then I pay myself 72% of my paycheck. What's left all goes over there, and I like making that transfer because it makes me feel good. I mean, 72% is a pretty big number.
Yeah, no, it's huge. You're definitely one of those minimalists. Amazing.
Well, again, a lot of that's eaten up by my mortgage payment and my car payment and stuff. But still, though, those things do provide value to my life, and they do build equity. And so, even though it's 72%, like it's really only like 30%, but it still feels good to pay myself 70%.
Yeah. Mortgage is one of those things that is, as we call, there is a bad debt and there's a good debt. This is one of those good debts that you can use and offset on your tax return. So it's all good.
Exactly. Yeah.
I don't see any more questions, folks. If you have any more questions, feel free to post. Otherwise, Matt, do you have any more questions? Are you good? Okay. Tyler, this has been amazing. Again, folks, I will be sending the recording along with Tyler's presentation. He'll share it with me and I'll share it with everyone else. Feel free to reach out to Tyler. Tyler, if anyone wants to reach out and talk, you said you guys work with entrepreneurs making 7 and 8 figures. Any particular industries, or are you open to any industry?
I mean, real estate is kind of first and foremost. We do a lot of tech entrepreneurs. So again, I talked about the sale of the business. If you own a C Corp, quite often, you're just only taking a salary out of that. But once you go to sell it, that's kind of their threshold. So a lot of tech people. And then we do have a lot of just, I guess there's not really a specific industry. I would say the majority are either tech or real estate, but we also work with like a podcaster that makes a few $1 million a year. A couple other, unique and interesting people. So.
Awesome. Very nice. Well, again, thank you so much, Tyler. Great presentation. Have a good night and good evening, everyone. We'll be in touch later. Take care, guys. Bye.
Thank you. Take care.
Bye.